Right, so private sector lender Federal Bank came out with its numbers, and what we have actually seen is a 13% rise in the standalone net profit, which came in at 541 crore rupees compared to 478 crores in the same period of last year. Net interest income, meanwhile, jumped 7% year on year to come in at 1,525 crore rupees. We did see the share price of Federal Bank post those results down about 2%. That was the reaction that we had seen. Joining us now is, of course, the top management. Live with us on the phone line, Ashutosh Khajuria, the ED of Federal Bank. Good morning. Thanks so much for giving us this interview. If I look at the NII growth, it is sluggish. What would you attribute that to? How should the street see the NIIs and the NIMs?
If you see the credit growth has been about 10.5%, and accordingly, I think yes, you're right that NII growth is at 7%. There were two main reasons for that. One is the expected growth in gold loan. That didn't happen because that's a high margin product, and particularly in fourth quarter, number one, there was certainly a very strong competitive pressure as far as gold loan is concerned. The interest rates had drastically, had come down. But the other important factor, that was a one-time thing or so, was basically some slippages on the agri book side. And in agri, you have more of the accumulated interest because there the benefit is of two crop seasons. If the account is overdue after one crop, the account is not classified as non-performing for another crop season. So as a result of that, when you classify it as an NPA on slippage, the interest reversal is much higher as compared to other segments. And this uniqueness is there only for agri advances. So I think that had been one of the reasons. So we had slightly higher slippages on the agri side. Though overall, if we see all segments put together, the credit quality was maintained quite well. GNPA came down. Cash recovery had been quite good. Cash recovery and upgradation had been quite good. But for this agri segment thing, there had been some drag on NII. But that was more than compensated from the other income part because that other income did very well. Core fee income did very well.
Okay. Going forward now, because if I see your CASA, there's going to be a 37%. But, things are going to change after what happened last week. You've had that rate hike surprise from the Reserve Bank of India. Cost of funds are going to go up. What's going to be the strategy going forward?
See, one is on ALM front, liabilities and assets are quite very well balanced. While we have advances linked to repo, and they get immediately repriced. As the recent repo hike, as and when it happened. And in future also, when further increases happen, the advances work to the extent of they being repo linked would immediately get repriced at a higher level. So cost of funds may move up a bit. When the interest rate cycle moves up, you will have a higher cost of funds. But so would be the yield on advances. And as I said, ALM is more balanced because we have savings bank which is linked to repo on one hand, and almost equal amount of advances also linked to repo. So that way it gets balanced out.
Fair enough. Your cost-to-income ratio, that stands at about 60%. Was that largely due to the one-off? And what is the quantum? Where do you see this number headed, or what would be the internal target?
Yeah, it's one-off. We had about 142 crores of unamortized family pension-related cost. So option was available to us to amortize it over next 4 years because the total period provided for amortization was 5 years by the regulator. But the only thing is we chose to take it upfront and fully take it on account. So about 142 crores worth of family pension related futuristic sort of cost was upfront.
Okay.
And if you remove that, cost income ratio would be same as what it had been in the earlier quarters. Same around 52%.
Okay. Now, on the asset quality front as well, you saw the gross performing NPAs that improved this time around to about 2.8%. The gross advances as well, from what we witnessed last year at about 3.4%. Net NPAs as well did see an improvement. What's the sense that you're getting in terms of your asset quality going forward?
So I think one particular thing which we can say with the conviction and which we have demonstrated over last few years, not only quarters, is the maintenance of credit quality. So credit quality, I think I would not be exaggerating if I may say we are in the top quartile amongst the top banks in the country as far as credit quality is performing, and consistently there are no sudden rises and falls there. So that's one part, and we are quite hopeful going forward. Also, the credit quality should maintain. And the best part of it is, of course, this do bring in some sort of questions on the lower NIM vis-a-vis the peers, because if you take little higher risk or so, the credit quality may get impacted. But on the other hand, there could be higher opportunity of earning this thing NIMs. But if you consistently see our risk-adjusted NIM minus credit cost, you would find that we are at par with the front-running banks or so. And this, is very, clearly evident in our credit cost, which was for the full year less than 50 basis points, 45 basis points for the full year. And if you see for quarter four, it's just 27 basis points. So credit cost is low. So I think that way, I think maybe portfolio is a little more skewed towards highly rated, portfolio, where the propensity to slip is much lower.
And incidentally, Federal Bank was one of the first to increase its deposit rates after the RBI surprise move. It did so a day after that action was announced by the governor. So the announcement came on Friday. With that, I'd like to thank you for being live with us today, taking us through the numbers. Yes, you saw the sluggishness in the NIs, but now the street will know the way forward with the top management being on your favorite channel and on the market.